Twilio stock is down almost 15% after reporting earnings. Is this an overreaction? Let's take a closer look in today's episode. So as we can see, Twilio's down roughly 14.8% today. Year to date, the stock is down roughly 5.5%. And unfortunately, from its 5-year max, the stock is down roughly 89%. So what I want to do in today's episode is do the following. Explain some of the reasons the stock is down, take a closer look at commentary and kind of their earnings report, presentation, and press release, and then just share my overall thoughts. Yesterday, I did do a video on PayPal, and I wanted to say for PayPal, I personally do believe it was an overreaction. And unfortunately for Twilio, unfortunately for Twilio, I wish I could have said the same. When I looked at it, I don't know if the 15% drop is needed, but there's definitely some reasons that investors might be worried right now. First, let's try to understand some of the reasons the stock price is down. First, they did miss in gross margins and kind of free cash flow estimates. They also are increasing their cash burn, or the cash burn did increase a bit. Next, they did see kind of revenue guidance for Q2 not truly meet expectations. And we also see things like this where dollar-based net expansion is kind of decreasing over the past few quarters. And then when we take a closer look at organic revenue growth, obviously due to macroeconomic trends, it is slowing down I don't know if dramatically, but it is slowing down quarter over quarter. And all this is kind of causing fear for investors. So first, I want to start off with their overall press release. First quarter revenue was $1.01 billion. That was up 15% year over year. In my opinion, and that's that is organic revenue growth, so that's great to hear. And again, with the overall trend that we're seeing in the market right now, any type of double-digit growth, in my opinion, is still pretty impressive. The company also mentioned that more than 300,000 active customers accounts are as of March of 31st, 2023, compared to more than 268,000 a year ago. So they are seeing customer growth on a year-over-year basis. Another thing that I was really excited to hear, and this is something they did announce in February, Twilio announced the authorization of share repurchase program to repurchase up to $1 billion of outstanding Class A common stock. And they did mention that they were going to use at least $500 million in the first 6 months. And Twilio, as of the moment, has already repurchased approximately 25% of the overall program, right? Of what they want to buy back. They did a nice amount of purchase in Q1. I'm going to guess another good portion is happening already in Q2. Taking a closer look at their outlook, unfortunately for Q2, revenue is somewhere between $900 and $990 million. This is expected a sequential drop, right? So that's obviously bad, and unfortunately did not meet analyst expectations. On the bright side, there's always some good news. They did raise the low end of its non-GAAP income from operation guidance for the full year of 2023. So for the full year of 2023, non-GAAP income from operations is between $275 million to $350 million. They only up the low end, so it kind of seems like they are at least becoming more efficient. And we're going to see in a bit, this is a company that has transformed themselves a bit, and that's something that investors might be worried about. So overall, I don't think anything's too crazy to my mind. Kind of seeing a weaker guidance isn't necessarily a huge red flag, but it is something to keep in mind outright because expectations do drive the market. Now, kind of focusing here on the company's income statement, a few things that I noticed, right? So we did see a nice growth in revenue, about 15%. Gross profit did increase as well, so that's great news. We also did see, unfortunately, an increase or a nice increase of total operating expenses. But the main reason is this company is going through a lot of restructuring, a lot of kind of headcount reduction, and all that comes at a cost. Restructuring cost is a big reason for that for total operating expenses to increase. If those restructuring costs were not there, total operating expenses would actually have been lower than a year ago, where in my opinion, that's really great news, right? It kind of shows that they are kind of leaning to a more efficient company. Unfortunately, it takes kind of a huge headwind for the market for them to see how efficient they can be. But like many companies have mentioned, this is the year of efficiency because of all these headwinds coming in. In forms of balance sheet, this is a company I personally wouldn't be worried about. They have roughly $4 billion in cash and short-term investments. It did drop a little bit, not too much when we take a closer look at total current assets, and that includes account receivables and prepaid expenses. So it did drop by about 100 million. Nothing crazy that I would again fear, but something to keep in mind now, especially since this company only has about $1 billion in long-term debt. So financially, not a company I would financially worry about. Another thing is this company did increase their stock-based compensation. Again, it does include some of those restructuring plans as well. So hopefully in the future, we do expect to see these decrease a nice amount. The other thing is this is one of the first few times that the company has repurchased shares. So if you kind of include that repurchase program, stock-based compensation, in my opinion, is expected to decrease dramatically over the next few, at least for the next few quarters, as they maintain this kind of buyback program. So overall, those were kind of the top level overview of numbers and if their financial statements that I found. Next, I want to take a closer look at some of the highlights. But before we go any further, guys, if you are enjoying, there are a few ways to kind of help out the channel. The first is hitting that subscribe, that thumbs up. I'm trying to get to 30,000 subscribers. Next, if you want to learn about the semiconductor market, I do have a background in master's in electrical engineering, and I did work for a lot of great companies, so I do have a semiconductor membership. Just click the join button below.
Finally, I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so now let's take a closer look at the revenue highlights, right? I mentioned revenue was up 15%, both on organic and just pure revenue growth. The company is now mainly split up into two markets. I'll explain a little bit more here. They have the data applications revenue, and that is roughly 120 million, 12% of total revenue. That was up 19%. Then they have the communication revenue, right? This is their core product. That was up 14%. In the top level, the company is saying that, hey, communication revenues, which is roughly 85% of our total revenue, we're in the mature place here. We're focused more on profitability than growth. When we take a closer look at the data application revenue, it's vice versa. We're focused more on growth than profitability at the moment. For those that are not familiar, data applications revenue includes revenue from Segment, Engage, Flex, and marketing campaigns. Their communication revenue includes revenue from their messaging, voice, and email communication APIs. So overall, we can see the huge distinction. It does seem like the company is kind of making a form of shift. And here we can take a closer look in the commentary that the CEO mentioned that right now they are working on new operating models consisting of the two businesses that I mentioned. They also have a new leadership structure, a reduction in headcount, and they have revised capital allocation on that plan that I mentioned for $1 billion in share repurchase program. So I want to say one of the fears, in my opinion, for investors right now is this company is changing too much in such a short time, especially during a time when there's some macro backdrop and some macro headwinds at the moment. Other thing that I believe investors are worried about is when we think of generative AI and how generative AI can kind of push this company away. They do mention that usually people might believe that, hey, generative AI can be important tool for things like conversation with customers for support and service use cases. And they believe that that's definitely true. They are focusing on this, right? This is what the CEO is now focusing on now that there have been a change in the overall leadership part. He has more time. He's focusing on the AI aspect. And the great thing about it is they do have a lot of great data with all the products that they have. So while they believe AI will be somewhat, I want to say, revolutionary or will be a disruptor for this market to some extent, they believe that they have the plenty amount of data to make it disruptive in their favor. And I do believe this is another reason why investors might be worried. They don't know how generative AI might affect the core business of this company. And I think that is a true fear, right? Obviously, management is on top of it. Rightfully so. They do have plenty of data and plenty of confidence. But in the real way, especially when it comes to communication and all these things we're seeing with large language models, I do believe it's rightfully so for certain investors to be a bit worried. It doesn't mean necessarily go sell out, but it's time to understand and add that to the bearish case. Overall, they do mention that the macroeconomics is obviously impacting their overall growth rate, as they do see some customers be more budget conscious and also kind of try to on contraction on renewal, and they also see lower average selling price with some customers where it obviously is being impacted by the overall current environment. Another thing kind of causing a headwind, and this is mainly on their core products, the communication, is they did see that crypto peaked a year ago. So it is kind of a hard comparison year over year, given the significant volumes that crypto users use in forms of messaging and everything else. So that's obviously a headwind, but they are bullish in the long term for themselves. Now, I do want to take a closer look at the guidance. We did hear a little bit more about them. One thing, though, that really stuck out to investors is non-GAAP income from operations fell really, really low. So 65 to 75 million for quarter two, where quarter one was roughly 104 million. So this might be freaking some investors out. You might be saying, hey, this is a company that's doing all these restructuring that's supposed to be efficient, but yet on a quarterly basis, they are expecting a lot less income from operations. The company did share some highlight there. Let's kind of go back to the commentaries that I had prepared. And they did mention that there's a few reasons for this. First, this quarter, they did get about a 12 million cash accrual, thanks to just some benefit, right? So an extra 12 million, that's obviously not going to come in quarter two. So that's going to have an impact. Unfortunately, they're also guiding for a lower revenue compared to quarter one, which is going to also impact non-GAAP income from operations. And finally, kind of all these shifts, they're shifting more from stock-based compensations to actually cash bonuses, as this company is trying to move away from, it seems, diluting shares, which can definitely be a good thing, and overall align better for their salespersons as well. So at the moment, that's also going to impact their non-GAAP income from operations. So again, nothing scary there, but again, it's kind of that fear of too much happening at one time. Now, in the long term of things, though, things are looking good. They do expect organic revenue 15 to 25% over the medium term. The medium term is defined as the years between 2025 and 2027. They also expect, again, improvement in improvements in their data application revenue. That's expected to grow at very, very fast pace. They also expect stock-based compensation to be much lower in the future, and they are targeting GAAP profitability for fiscal year of 2027. That's pretty far in the future. So again, some investors might be saying, hey, we don't have that time to wait for that profitability that you guys are expected to see 4 years from now. So overall, I want to say there wasn't too much negativity in the stock, in my opinion, from what we saw. The things that did kind of have some form of flags, in my opinion, did have a reason for it. It wasn't kind of hey, we're just guiding for a lower non-GAAP operating income. I think the biggest drop here is just the uncertainty of everything that's happening. Brand new kind of leadership style, brand new modeling style, brand new business in general to some extent, and how they're handling it. Then the kind of the threat with generative AI, then kind of the macroeconomics. There's just so much uncertainty right now that it is fearing investors, and they want to price it rightfully so. Obviously, if all that goes well and generative AI doesn't really become a true threat, I think this is a great buying opportunity. If you fear like those threats are too much risk, then obviously this is one to step away. For me personally, I'm not selling, but it is something that I'm not probably buying right now, and it's gonna have to wait to see how I feel more comfortable of where technology is moving. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.